Hi, and thanks for listening to Total Access and Impact. Total Access and Impact is sponsored by Rental Karma, where good renters deserve good credit. Check it out at rentalkarma.com, and that's spelled KHARMA.
Welcome back, everybody. Today is February 29th. We got a very special leap year celebration episode for you, talking about how to buy a home. We hear about that all the time, right? Mortgage rates are high. It's hard to buy a house. All of the things you got to do for savings, and there's all this complication to it, and so forth. Well, it's kind of designed to make it a little confusing because, well, I don't know. Part of the process, I guess. But the reality is it's really not that hard, and there's something that we're going to give you some insight to today that makes this really easy, and that is how to buy a house with no down payment in your state, in your community, in your town.
Mm-hmm.
You can do that? Well, Cullen, you just had an episode that said buy a car with no down payment. Why does everybody say I got to save for a down payment?
Because they're lying.
Yeah. Quiz question. What percentage of Americans have less than $1,000 in savings? Wendy, I know you know the answer to this because I say it a lot.
Mm-hmm.
Go ahead and tell everybody.
70% of Americans do not have $1,000 in savings.
70%? That's got to be like a world record. There's got to be, every country in the world's got to be able to beat that. That's not that hard to beat.
Yeah.
That's crazy.
Yeah, no, it's insane. It's insane.
So that's easy
and it's hard
to say
do.
that 70% live paycheck to paycheck.
Mm-hmm. Yeah.
Okay.
Easy peasy.
And when you rent an apartment, if you don't pay the rent by the 5th, you're in most states, they'll stick a little sticker on the door that can say pay or quit, and they can have you evicted by the 15th or sure the 20th of the month if they're pretty aggressive. Is that right? Yeah.
Sounds about 15, 30 days. Kind of depends on where you live.
You're not going to make it to a 30-day late at all. Okay. You're going to be, your stuff's going to be on the curb. Well, when you have a mortgage, if you get to a 30-day late, yeah, you're going to get a late on your credit report. Okay. 1 30-day late. And you're probably going to have like a $25 late fee. But the foreclosure process ain't happening. Okay. That doesn't start until at least 3 months. And when their economy is tough, back when 2008 happened, it was taking 9 months to over a year for that to start. Okay. Which, do we all want to just not pay our mortgage for 9 months? No. But if you have a bump in the road or something crazy happens, having a month or two to get that fixed is huge.
Mm-hmm.
You shouldn't have to go out on the street just because you missed that one payment and you got to 30 days late. So everybody remembers back in 2008, right, when there was a huge amount of foreclosures because of the mortgage crisis, whatever we called it, which was basically crooked banks that caused the problem, and greedy mortgage loan officers that no longer do that business.
Mm-hmm.
Well, that process, then would take months and months to get it done. But the reality is mortgages, they don't start for foreclosure process in normal times until you get to 90 days late. Okay, they give you time to get things taken care of. Well, it's just common sense. One, it's expensive. The bank doesn't want your house. Two, everybody's got blips in their life, especially when you live in this. 70% of us have less than 1,000 in savings. It's just a paycheck to paycheck society. So, what can we do? Well, not having to save up for a down payment is really cool, right? And the fact that we have this is incredibly important. And you're like, well, why wouldn't I have heard about this, Cullen? Wendy, why didn't I hear about this? It should be on the news, right?
Yeah.
This should be a regular thing. Well, I'm going to give you the insight, okay? Mortgage brokers, the people that sell mortgages, they don't get, I don't believe they make as good a commission on processing and just doing the paperwork. So mortgage brokers, they get paid on commission, okay? Very few get paid as a salary. Like at a credit union, they do, but most of them work on a commission.
Mm-hmm.
And they make more money off of other loans in their commission. So they're less interested in doing this, okay? And a lot of times it's a bit more work for them or something along those lines. There's something in the gray thing here why they're not pushing it, okay? But here's the reality. 49 of the 50 states in this country have a down payment assistance program for buying a home. They have income limits, and it's set state by state. And you're like, oh, this must just be for poor people.
Nope.
Nope.
Nope. Not at all.
It's for me. I literally qualify
It's for you.
in pretty
and
much
you,
every
and you.
state, and everybody qualify. Okay, and if you work in San Francisco, you can make up to $300,000 a year and qualify for up to $150,000. Okay, all right.
Yeah.
And each program in each state varies. Like some of them have really smart programs. It's like, wow, I was like California. They just went over. We're talking about it in a minute. Like, whoa, that's really bright. That's a good way to fund something. That's like smart business. That's not government, and so forth. But there's state programs, okay, and then there's a couple that are national, and we'll talk a little bit about those, okay. But it's incredibly important because it makes home ownership incredibly attainable to the point where you gotta have a job, you do need a credit score, and it can't be 580. Okay, you got to be credit ready. It's usually 640 minimum, 660, 680, but we just say credit ready at Rental Karma is 720. Okay, get there. Okay, it's not hard at all. It is really not hard. You just need to know the steps, and that's all. Okay, so I'm about to get into the why, folks, of why this is the thing. But beforehand, I'm going to preface we're going to have two dirty little secrets today. Okay, I always like to have dirty little secrets because it's important for education. Okay, and we take something that sounds complicated and tell you the reality. Okay, and sometimes you can do something about it, sometimes you can't. Okay, but one of those dirty little secrets, Wendy, is the one with the big A. What's that one?
The amortization schedule.
Yeah. Okay.
Yeah.
So what the hell does that word mean, right? Yeah. 6th grade English teacher. No, nobody taught you that. If you took a advanced finance class in college, you might have heard it, and you had to take it in the test, and you're like, well, it didn't make any sense to you. Okay. Yeah. The other one is what is very popular. This one is very popular. And Wendy, what is that one?
That is the refinancing of a mortgage.
Okay.
Yeah,
so
there's
like
pitfalls to it.
Yeah. So like nobody's doing it today, but when it gets popular is when interest rates fall, like they did a couple of years ago. They went down to like 3 and 4%.
Mm-hmm.
People, the marketing. We'll just talk about that when we get to that, okay? But that's the other one we're going to talk about, those two dirty little secrets, okay? Now let's talk about the why. Why is this, Cullen and Wendy, this down payment thing? What's the deal? Why are they doing that? Okay? And Wendy, she and I were talking about this yesterday and off air, and she was surprised about it. Really, yeah. I mean, there was some like, what's the reason for that? And to reiterate, it's not for people it's not for poor people, okay? It's not welfare, okay? What it is that states compete for humans, okay? If you don't have a workforce to go and work at the new, the states, they work hard to get, like, in Tennessee recently and in Alabama, there's a couple new car plants that came to America. And it was big in the news because you bring a Volkswagen plant to your community, that's like 20,000 jobs, right?
Yeah.
Well, if you don't have that many people around, and you got people that are having to commute an hour or whatever to go to that job, that doesn't work. So these towns and cities and states are all competing for quality people, okay? And they like to have affordable homes. They like to have low cost of living. They like to have good schools, etc. And all that takes people living in their community, owning homes, paying taxes for property, etc., that get reinvested in your community. Everybody wants to live in a good community, right? I don't know anybody that's ever said that, but they don't.
I want to live in a crappy place.
I mean, that's like nobody on this planet wants that, right?
That.
That's why we have migration. That's why people come to our country, and then why people in our country leave and go to other countries or other states, because they want a different scene, or different climate, or whatever the case may be. And so the states, they're recruiting, and in different states there's different economics, right? Tennessee, it's getting more expensive than it was 10 years ago. Thanks, Nashville. Thanks, Knoxville. The secret's out. Sorry, Tennessee. Tennessee's the new Colorado. 20 years
Yeah.
ago, when I moved to Colorado, it was a deal. Now it's through the roof and out of control, to the
Yeah.
point where they can't even get teachers. They're having to give like crazy deals for housing to teachers just to get people in the communities because it's so expensive. Okay. But then there's other places that are still less expensive. Think of Arkansas, and people even think Texas. Well, Texas has got these big cities, but yeah, it's got a ton of rural areas too, and they still have generous programs. Well, how do these programs work? One thing to remember is this, okay? And we're going to share in the show notes a list of the links to every program, okay, in your state. And you're like, well, are there 3 programs in the state of Arizona? There's one that I'm going to send you to, and that's the one that was run by the state. If there's anything else, I would be highly doing my utmost research about it, okay? Because these are all sanctioned by the state, okay? So if there's something else you come across on Google, it might not be it, okay? But they all have the same sort of theme, and that is to make sure that that there's money available to cover your down payment and closing costs. Okay? 70% of Americans don't have.
$1,000 in savings.
See? It's the elephant in the room, guys.
Yeah, because it sucks.
I mean, it's
It sucks.
unbelievable. If I said that stat in Australia, they'd look at you like you're freaking crazy.
Mm-hmm.
What are you talking about? Maybe 70% of 18-year-olds don't have $1,000, but not the regular population. No way. That's just not how it goes. And it's not that they're better savers. They just have different systems in place. One is to promote homeownership, their wages, and there's just some basics that they protect their jobs. Bananas. You know how much bananas are in Australia?
I was gonna say, oh gosh, probably like 30 or 40 cents.
No, they're about $3 a kilo, which is about $6 a pound. Why? Because they don't get them from South America. They get them in Australia, where people make $25 an hour picking bananas off the tree. That's the difference. They grow them at home, and they don't allow cheap imports of food. They can grow their own. They say we're not going to allow it. They can get them from the Philippines, but they choose not to.
That's good, though. Support that local economy.
Yeah, so hence why they don't have the problem that 70% of Australians have way more than $1,000 in savings. Okay.
Now I want to know what percentage of Australians.
Yes. I bet you can't even find the stat because it's not even an issue. It's probably not even an issue. Sorry, folks, I had to take a break. Flight for Life just landed outside my road here on this crazy busy highway. And Wendy just cracked a joke off air. Go ahead and share your joke, Wendy.
I said the government's here, and they're because I know we're talking about all these good deals.
It's the federal government then, because the state governments are the one that are doing the program. They're just, you know what? State governments are not good marketers. They're not. They're not good marketers at anything to let people know that these things are available. So that's part of what we're doing for them is free marketing. I'm going to send a bill to each state for marketing services rendered. How much do you think it should be?
Thanks for the business.
Yeah, it's like $5,000 worth of easy. If they get just one new family, then that's great.
Tax revenue keeps those wheels running.
Yeah. So let's talk about the different programs that we found. So we're talking about Georgia, Texas, Florida, California. Okay. And remember, 49 of the 50 states have a program. I think the only one that doesn't is Hawaii, but I'm still going to do some research because maybe they have. There was the terrible fire that threw things out of whack there for a bit. But in Georgia, Wendy, I know it's called the Georgia Dream Homeownership Program.
Hmm.
You did some research on the specifics of it. What did you find for the Georgia Dream?
So pretty much Georgia Dream, it is like most of the programs, income based, and it is targeted for first time home buyers. Now, real quick, first time home buyer does not always mean first time home buyer. It just means
Uh,
you haven't had a house in 3 years. So you don't
okay,
have to be a real true first time home buyer. You can be a first time home buyer within the last 3 years. And then
which
also,
is confusing as heck
mhm,
because if you are a consumer and you go and you read this, say you're in Georgia and you just a lot of because of our attention spans. So thanks Steve Jobs for the smartphone. But if you're just scrolling through and then you see that okay, credit score 640 or whatever, right? And then you see the word first time home buyer and you go, well, I was married 10 years ago and we had a divorce 5 years ago and I'm not a first time home buyer. You might just stop right there,
yeah,
right?
just disqualify yourself
What a
from it.
terrible word to use because you just selected yourself right out of the process.
Yeah.
So no, you don't have to be a quote unquote first time home buyer. Wendy just told us that. Okay.
No.
So what are the other things?
Well, and then also back to that. Now there are like half of the counties, or over half rather, in Georgia that you don't even have. They don't even have that requirement specifically, just because they're trying to get residents into those areas. So, like, there's a
Oh
map,
yeah.
and we'll have this in the show notes as well. There is a map of, like, again, over half the counties in Georgia where that first time home buyer isn't even a requirement. They just want you there. And now you do have to complete an education course for that home buying program,
Yeah.
but that's, again, that little 8-hour class is going to save you thousands and thousands of dollars. So
Yeah.
the Georgia program is really, really great. And especially where you can move to that state, and again, without you know being having to pay any down payment and things like that, because it's specifically for down payment assistance.
Yeah.
And it can be used in conjunction with other loans too, but of course most of these programs can be used in conjunction with other
Okay. So if
loans.
you have extra money, it's not a penalty against you. You can actually use that with it, but it's also just there because they want you there. So we talked earlier income differences. What's the income limit in Georgia?
$74,000, which is still really,
That's
a
pretty
good
healthy in
wage.
Georgia,
Hmm.
right?
Yep.
Georgia's
And
not California for sure. I mean, that's a you, that's a college that's a person with a college degree and a professional job making a pretty good living, 74K in Georgia.
and it was just great. And they also put $5,000 down towards the down payment. And if you're a
Okay.
first responder, like a police, fire, also in some areas they count teachers as first responders as well. So check your programs and check your areas. But you can get up to $7,500 instead of just
Oh
$5,000
yeah,
towards
yeah,
your down
yeah.
payment.
Yep. Yeah, I've seen that too. So and military fall into
Hmm.
that too.
Yeah.
Yeah, if for some reason you're not using your VA loan. But cool. Well, that's pretty sweet. Let's go back down to Texas. So Texas, they're big state, some big cities there that are, they got some big houses in Texas, but they also got a lot of land and a lot of communities that are growing. There's a lot of companies that relocate to Texas,
Hmm.
need workers, all that good stuff. Um, what did you find out in terms of Texas, how that program works?
Pretty much, it seems like it's a lot of the same as like with Georgia. Of course, it has to be first time home buyer. Again, there's that first time home buying thing again. But also they do have to have a housing course as well, which is just fine. If again, that little course will save you thousands of dollars, but they're able to give you 2 to 5% of the loan value as down
Oh, up to
payment
5%.
assistance.
Okay.
Yeah.
So
So
$300,000 house, 15 grand.
yeah, which is great. And
Okay.
closing doesn't typically count that cost that much. So
Yeah. And so in Georgia's program and Texas's program, it's a grant to you. Now, I know that the states they have requirements that are part of the fine print, which are you can't sell the house like for at least 3 or 5 years, something like that,
Mm-hmm.
to just turn around and try and walk away with the money they gave you, if somebody was even that silly to try and do that. But oh yeah, so there, I see your note. In Texas, it's a 3-year forgivable second mortgage. So if you happen to sell the house after a year because you had to move,
Mm-hmm.
then you are required, the mortgage would get paid off when you sell the house, out of the equity from the house or whatever. However, if you stay in 4th year or more, you sell the house, that second mortgage is 0, and you don't have to pay anything back on it.
Awesome.
That's how that works. Yeah, that's
That's a
pretty
big
cool.
help, especially because
Yeah,
moving's
and
expensive.
yeah, and I know in just for clarity, the first time homebuyer thing in Texas, did it have that same stipulation that they did in others where it's
It did not look like it had any kind of a
okay,
difference. It looked like it didn't have to be a first generation home, which means that no one in that generation has owned a home,
okay.
which is kind of strange. But but no, it didn't seem to have those same kind of or it has this like the
It's
similar
another situation where it's a misleading phrase.
Mhm.
Okay,
Yeah.
got it. So we'll make sure that everybody got that straight. I'm pretty sure most states that's going to be the case. There might be some place that they haven't, but remember, the Bureau Correct created this, so it maybe isn't as clear as it should be. That might be the thing. Okay,
That's why
cool.
we're here.
Yeah, I did, and I remember because I've done this over time. I've looked at Texas, like Georgia. They had basically a flat rate no matter where you're at in the state. Okay, of what you're getting, $5,000, right, or 7,500. In Texas, and they had their income caps was basically if you live in Atlanta or in the rural area, how much money you could make. But in Texas, they actually do it by geographic region. So there's a tool on the Texas website. You go and you click your county, and it'll tell you if you live in whatever the county is in Austin, that you can you get whatever. It's pretty generous, like $90,000. Okay, is your income cap. If you're in or Houston or Dallas or whatever, it varies there as well. If you're in more rural areas, the number goes down just a little bit, but it's still just the same. It is not. It's for us. It's for all of us. This is not welfare. It is to get you in that community so you become a stable part of the community. Okay,
Mhm.
so go check it
Absolutely.
out. That's awesome. All right, next we're going to talk Florida. I'm going to give it a little. The cat on Florida was. I know that the income thing works like it does in Texas. It's based
Mhm.
on the county or area you're at.
Yeah.
But what's the max you can get in Florida? Do you know what that number is?
You can get up to $10,000 towards the actual purchase price. As far as the income limit itself, it doesn't. I didn't see just
That one's by
directly.
county down there.
I was gonna say, I
It's
want
the
to say it's
same.
by county,
Yeah.
and it
Yeah.
looks like that, you do, of course, like the others, you have to complete a course, as
Yep.
far as like a first time home or like a home buying course, and then of course minimum credit score of 640, but again, we want you to be at more 720, just so you're more credit ready, and also you'll be paying less interest.
Yeah.
But yeah, so and as far as Florida goes as well, again, you get up to $10,000 towards the down payment assistance. So whether you are trying to move to, Appalach or, Miami, you either way you get $10,000 towards your down payment.
Yeah. As long as you're not a millionaire.
Mm-hmm.
Yeah.
Yeah.
Cool. Well, that's pretty sweet. I'm going to next talk about California, and then we'll do our dirty little secrets. Okay. So next, let's talk about California. I just researched California, and I'm really impressed. Okay. What a smart program they have there. This is what makes sense. Okay. Some people are like, well, why are they just giving the money away? It's welfare. No, it's not. It's that we already explained that. Okay. It's not hash it out. California got smart about it. They said this is an investment in our community, and we can all win. They have a couple of programs, but the one I looked at, and when I say a couple of programs, the programs are within the same organization that the state runs. Okay, it's like California Housing Finance Agency. Okay, it's called the California Dream Home Ownership Program. you can get up to $150,000 for the down payment. What, Wendy? What did I just say? How much?
$150,000 towards your down payment. $150,000. Like, that's like almost a house. Well, that is a house here.
California, everybody thinks California's crazy if you don't live there, right? People dish it all the time. It's the 7th biggest economy in the world. Okay, they figured out a few things. Okay, they're producing all these nice electric cars that everybody's clamoring over. Now, by the way, if you go to California lately, the electric cars are everywhere. They're like flies in Alabama. Okay, or mosquitoes in Georgia. They're everywhere. Here's the program: $150,000. Okay, up to. You don't have to take the whole amount. Okay. But the purpose of it is they want you to have 20% for a down payment on a house. So let's say it's $500,000. 20% reduces it to a $400,000 mortgage. Now, this is a regular mortgage that you end up getting, okay?
Mm.
Just like Fannie Mae process, okay? And now, because you have 20% down, you don't pay mortgage insurance included in your mortgage payment. What they do is they want you to get that because then it becomes affordable. The home becomes affordable to you. Well, where's this money come from? Well, they got a big pot of money, and they do is they give it out for this, okay? And the deal is that money is given to you interest free, and you don't pay it back on a monthly basis. You pay it back when the sale of the house happens. Okay? You decide to move to a bigger house, whatever it is. Say you've been there 5 years. Well, we want to move. Okay, fine. Sell the house. The price of the house went from $500,000 to $600,000. Just say, okay. So there's $100,000 in equity. Sell the house, $600,000. $100,000 of it, $100,000 goes back to the state of California for the $100,000 they put in for the down payment. The mortgage company that you got your mortgage with, well, that money comes out, and let's say you had paid that down from $400,000 to $350,000, just for easy math. Okay, now there's $50,000 in equity from that, so there's $150,000 left at the end of the day, right? Mm-hmm. Well, of the part of that that's the appreciation, which is the $100,000, $500,000 to $600,000, you're going to split that with the state of California, but not 50-50. You get 80% of it, and you're giving 20% back to the state. So the state actually made $20,000 on their money over the course of 5 years. It's not that bad. It's actually a good investment. And now they got that money. They can turn around and give it right to the next person, right to the next family, right? Everybody wins.
Yep.
That's brilliant.
Yeah, that truly incentivizes like ownership. And especially like people are exiting the states like so quickly. This is a great way to bring in and retain those people. That's just amazing. What a great idea.
You know what they do have in California? Really good schools. Okay. What's the catch? Well, you got to live in California. Call it the California Dream. They make songs about it. The Eagles.
Yeah.
But so that's what it is. So for all those folks that live in California, you didn't know this exists. You probably do because you're smart and checking these things out. But go check that thing out because it's a no-brainer way to go through it, and so go from there. So let's jump into dirty little secrets. Okay. The first one is called amortization schedule. All right. This is incredibly painful. And what Wendy will do for those on the video is maybe put a screenshot over this that shows what the payment happens is. But in short, amortization schedules, they apply to mortgages, personal loans, car loans, and student loans. Okay? Here's the crazy part. Let's just pick an easy interest rate, 7%. Okay? And if you have a 7% interest rate on $100,000, Simple interest is $7,000 a year, right? If it's a 10-year loan, you would think then that it's whatever that is times 10 years, so 70,000 over 100,000. So it's less because you're paying it down over time, right? But what happens is they have this. I don't even know how they came up with it. It's mystifying. But if you go and Google amortization schedule, you can find one on bankrate.com. That's the one I've seen. They hide it. You have to look for the word schedule sometimes. Okay.
Mhm.
And you plug in the amount, 100,000, 7%. And I'm going to do it right now so that you can. So I just pulled one up on bankrate.com. Okay. And I put in the calculator $100,000, 30 years, 7% interest. Well, it's not because I know it's not a $100,000 house, but just if it's a $400,000 house, multiply by 4. Okay. This is just for easy math and understanding. At 7%. In the first year of the mortgage, the first 12 payments you make, $665 is the monthly payment. Okay. Only $841 is going towards the principal of the loan. $5,800 is going towards interest. Your balance on the loan at the end of the year is still $99,158.
Yeah.
How on earth is that 7%?
Because
No
of
calculator.
amortization.
Yes. Okay. Let's go down to year 10. By the time you're in year 10, you have paid $86,000 on the mortgage at $665 a month. You have reduced the principal from $100,000 all the way down to $84,000, $16,000. Wait, Cullen, you just told me I just paid $86,000. What do you mean it's only 15? Because they stair step it and they stack. They pile up what the total interest would be on 7% over 30 years. Okay, so they can get away with saying 7% APR.
Mm-hmm.
That's how they get it. This is the fine print of the bull, the bull in the barn, man. And then they schedule it out over 30 years. So then by the time you get to year 30, you'll see that, or let's say year 29, okay? Your monthly payment, you're paying 685, whatever, 665, the number, yeah, 665. 613 is going towards principal, and $52 is going towards interest. That sounds a bit more normal, right? So you're finally at the end of your loan, you're really knocking your principal out. Okay, it really kicks in at the end of it. Okay. Still, this makes no sense, right? What is the average person? How long does the average person stay in their house?
Like 5 to 7 years. Some people stay up to 12. I think the national average is like 12.1, but
yeah, the 12. So 12 was the average, right?
mm-hmm.
But then you kick in with that thing called mortgage refinance, right?
Yeah.
Which is the other secret we'll talk about. And so when you have the average family is only going to stay in their house for 12 years, well, by the time you get to 12 years on this calculator, let's see, that would be 2036. You have only paid off $20,000 in principal on the $100,000, and you paid $82,000 in interest. You only knocked that balance down to $79,000. Why do you think Dave Ramsey teaches people, if you have a mortgage, to pay on it extra payments every time you can? Well, that's one of the reasons you can knock that down. But still, it's like sweeping crumbs off the table. Is it real? I mean, is it really making that big of a difference? It's making a difference, yes, but not a huge one. It doesn't kill the amortization thing at all. The devil.
It's like you have to be very, very careful that when you do make those payments that you pay like like more than what the average principal is each month. So it's like, so then every payment could technically be 2 payments off the back end, but you can't just throw $5 here, $6 there. You have to be more aggressive with
Yeah,
actually paying those off. And
you do.
let's be honest, who has enough money to be aggressively paying on their mortgage with
Yeah.
leftover funds? No one has extra funds right now.
Yeah. So that's the crazy part of this. So, and that's on $100,000, folks. The math stays the same. So if you multiply that by 3 for 300 grand, there it is. Go use the calculator over Bankrate, and make sure you click on where it's first it'll say chart right underneath monthly payment, and then click on schedule. Okay. There's gonna be a screenshot of this in the video that when we posted up to YouTube and to our app and other places. Okay, so that's that. Now, the average family, we talked about refinancing, right? We can become victim of the marketing of it, for one. Interest rates are at an all-time low. Refinance your loan. If you're at a high 5% rate and you can get 4% today, you can save $150 a month on your payment. That's the marketing message.
Yeah.
You ever heard that on the radio? Ever seen that on TV?
Oh, yeah.
A lot, right? Well, one, the mortgage person makes another big commission refinancing the mortgage. That's one. Is it a true marketing message? If you go from a 6% to a 4% on your $300,000 mortgage balance, yeah, you're going to save a couple $100. No question about it. Okay. Each month. This kind of ties into the car stuff. It drives me nuts and how it's sold. But at the end of the day, guess what happens? The amortization schedule hits the reboot button. You start all over. And there is not one commercial for mortgage refinance that tells you that. Not one. And if somebody knocks at my door right now and he looks shady, it's the mortgage mafia coming after me. Okay? Because that's the dirty little secret they're not going to tell you about. Could you imagine that you've been in that house for 10 years and you've managed to pay down a whopping $15,000 off of the principal, even though you spent $85,000 already?
Yeah.
And now you're going to go reboot the button to save $200 a month?
Yeah, my brain was doing that in percentages. It was going like, so this no compute. Yeah. This no compute.
At year 10, Wendy, on the calculator, at year 10 of your 665, you're still paying $502 a month in interest and only $162 towards the principal. So you got to be careful of that. And you know what's so funny about the mortgage refund? You can get some cash out. Would you like to take some of that equity and pay off some debt? You ever heard that one? That's the marketing message.
Oh, yeah.
It has nothing to do with your resetting the clock on the other. And they're like, well, your house is worth more today than it was then, right? Take some of that equity out and pay down your credit card debt.
I bet the amortization. I bet the amortization schedule is not the same on reverse mortgages. I bet they do not give you your interest first.
I think I think there's a person in history whose last name was Amaterize or something, Mr. Amaterize, and he was the richest, most unliked human in time, and everybody disliked him so much because he lived on the hill in the biggest house and the biggest, and he didn't even have, he was so wealthy he didn't even have neighbors, right? He didn't live in a fancy neighborhood. He literally just lived in his own neighborhood on like 6,000 acres of prime, beautiful rolling hills, right? And all these other people said, I want to be like Mr. Amaterize. And then they became bankers.
I bet he's slinging like high-end hot tubs down in hill with an amortization schedule on them as well.
Oh, yeah, that guy, if there's a God, there's no way on earth this person's in heaven. No way, no how. Okay, well, I hope you're enjoying this. If the salt shaker's empty, good. It should be. As you know, we want to make sure you pour salt on any wounds that you have because it stings and burns, and we have to learn around the process of this. How do you get around an amortization schedule? Kind of one, you have to suck it up the first time. But in the example of like the California down payment thing, your house goes up that much. Take that equity and put as much down on your next mortgage as you can, and don't maybe buy the fancier house. Go buy one that's the same amount or even less if you don't need it. How many people, older people you know that are 60 years old living in houses that are $1 million? It's a crazy thing. Okay. You don't need that much house. But if you go and then take that money from that and say you go buy another $400,000 house or whatever, go get a 10-year mortgage instead. And you go look at the amortization calculator on a 10-year mortgage. I'll switch it right here on the screen. You can do that easily in the think rate thing. It's very slick. Guess what? By the time you're in year 5 of your mortgage, you've already paid off $39,000 on the mortgage and only $27,000 in interest.
Yeah.
Of the 60 grand you paid, right? Just go get a short-term 10-year mortgage. Use the equity you got from that one smart transaction you made.
Mm-hmm.
And now, when you get to the time 10 years is done, you have a $400,000 house that's paid off.
Yeah.
You go cash that thing out and you go move wherever the heck you want. And the next thing you buy, you just pay cash for it.
Yeah. Absolutely. It's like,
Yeah.
heck, even take the equity and like put it in a high yield savings account, get 5% on that, and then use that as a slush fund to pay off the mortgage. You're going to be saving yourself so much money in the long run.
Yeah. Wendy, I have to admit, we talked about having another dirty little secret, and I got so worked up about this, I forgot what it was.
Mortgage insurance.
Oh, God. Oh, for heaven's
The
sakes.
scam and a scam.
Don't cut that out of the video, please, or out of the show, because you know what? That you just, oh my gosh. I gotta have a drink of water here. Sorry.
We may have to switch to something stronger.
Yeah. I think all I have is a beer and IPA, but you know what? It's 5:30 somewhere. Isn't that what that song says? Jimmy Buffett? It's 5 o'clock somewhere.
Hell yes, it is.
Yeah. Oh, God. Okay. So mortgage insurance. What do you mean? If my house gets sick, I take it to the doctor and they cover the bill?
I wish
No.
it was like that.
If my gutter gets clogged and I have the guy come out and fix my gutter, my mortgage insurance covers it? No. Oh, there's homeowners insurance also. Homeowners insurance covers your house when in case it burns down or a tornado hits it or a hailstorm ruins your roof and you got to get a new roof. Stuff like that, right?
Sometimes.
Oh, you're telling me sometimes they deny your claims.
Oh, yeah. My new roof claim got denied, and I'm like, then why am I paying you? And no, my husband is not home.
And it's required.
It's required.
By the mortgage company because they don't want the value of your property to go down of what they mortgaged the house for. Okay, so that sounds like it's a pretty legitimate scam too, and it might just make the list.
Mm-hmm.
Think about that one.
Yeah.
You have to talk me out of it not making the list, Wendy, okay? Because right now you're all in. I can tell.
Oh, yeah, no.
Pissed.
I'm still mad at a company. It's called, or let's say it rhymes with Pate Barnes. Yeah, no.
Oh.
Yeah,
Yeah,
no.
the red shirt people.
Yeah, no, they were not a good neighbor in that situation. I was very upset.
Okay.
I'm still mad. It's been 7 years. I'm still mad.
Oh my Lord. So mortgage insurance. How much is mortgage insurance? So mortgage insurance, just did the calculator over, I think it's bank rate again.
12 bank rate.
10% of your monthly payment is to pay a thing called mortgage insurance. This one says $2,600 a month payment for a $300,000 loan, 3% down. Of that $2,600, $240 is going to some company called a mortgage insurance company. 10%, okay, times 10, 240 times 12 is like $3,000 a year. Okay, what does this cover? Do you know what it covers?
Like,
Wendy?
I literally have no idea. Like, I've heard of
You're
it.
kidding me.
Like,
Oh
I've
my
heard of
Lord. If
it.
for any reason you default and get foreclosed on and the housing market collapses and the amount owed on the mortgage, even when we had this crazy thing called the amortization schedule and all you're paying is interest,
Mm-hmm.
let's say the value of the house goes from 300 to 250,000. The mortgage insurance is going to come in and make the extra $50,000 payment to the bank so they don't lose out on the mortgage.
So I feel like you're having to pay for the bet that the bank's betting against you for.
You're paying the premium for to insure the bank.
Rude.
It's
You got
not
more
even
money than I do.
You get nothing out of this. You get absolutely nothing out of this.
Nothing.
Okay? Nothing.
Nothing.
Absolutely nothing. Except 10% of your payments going towards that. And oh, by the way, it's bundled in and you're paying interest on that money as well. Because it's part of your premium. Or it's part of your mortgage payment. And then the only way it goes away is when you get to 80% equity in your home. And that could be through paying your payments down. Well, we saw how long it takes to get your payments down with an amortization schedule. It takes forever in a year.
Mm-hmm.
Okay. Or forever in a lifetime, I should say. And if the market is going up and your home is appreciating and it gets to where your $400,000 house is now 500, that's 80% of what it would have been, right? You can go to the mortgage company and you have to, I think, get a new appraisal, and you have to go through a process to prove to the mortgage lender that your house is worth more now, so there's not risk to the lender, and get them to drop the mortgage insurance premium off of your payment. It just doesn't magically go away, because the bank doesn't magically know when and if your house got to 80%, unless it was just through payments, which through an amortization schedule. If you go back to that and look at it,
Mm-hmm.
how long will it take for you to get to 80% loan to value on the bank amortization schedule?
Let's say so.
On the 30.
I was gonna say on a 30. Let me guess. On a 30, I would say about 21, 22 years in.
So you got to get to where you've got 20 paid off in the principal. 12 years. After 12 years, you would get there. And you've paid in 12 years, you've paid $3,000 a year times 12, $36,000 in insurance to insure the bank that you weren't going to default and get foreclosed on.
It's insane. And you don't get any of it back. That's the worst
No,
part.
there's no refund. It's not
There's
like
no refund.
taxes. You know, you get taxes paid out of your paycheck, and then if you have certain expenses or child tax credits or whatever, you can get a tax refund. The government will actually be fair and give you part of it back. Ain't no such thing with the mortgage insurance. So that's what is one of the things that makes that California program really smart.
Mm-hmm.
There's no mortgage insurance because you're at 80% to start off on day one.
Yeah. That's incredible. That's incredible. And the
Absolutely.
housing bubble is in the process of popping. The houses are finally starting to go down in price. So
Yep.
no, I know people are like, oh, it's too expensive to live in California. But it's not really. It depends on where you're looking. So just, don't give up on your dreams of buying a home just because, prices are a little high right now and interest rates are a little high right now. The bubble's popping.
Yep.
It's happening. So just look at it as more time to save up for your down payment.
Yeah.
Which you don't need if you use one of these programs.
Yeah, no kidding. So at the end here, I'm going to give you just a quick thing on the couple other loan programs there are. Okay. and some of them do have no down payment. If you're a veteran, you very much know there's a thing called a VA, the VA and the VA loan. Okay, no down payment, no mortgage insurance, smart, and you don't have to have as good of a credit score. Doesn't mean you should walk in there with a 581 credit score and feel good about yourself. Get yourself credit ready, 720. If you don't know how to do it, call Rental Karma, get your rent add on, get a coach, and get yourself to 720 in weeks. All right? Simple, not hard. And congratulations. That's a great reward for being in the military that you get that deal on your mortgage. Okay? That's a great step. And you're crazy not to use the benefit. There's also a thing called the FHA. They have programs like that. They, I don't think they're nearly as cool as the one in California. So check whatever your state is and compare it to an FHA loan and see if it's different. But the thing that I don't like about the FHA loan is they have this low credit score threshold. If you go to 720, this threshold of having a low score just doesn't even matter, folks. Okay? Just get credit ready. That's all. It's not hard. All right. It is not rocket science, and we'll be teaching that in this class. I'm gonna give it to you here in the next week or two. We're gonna be explaining why. Don't think about a credit score 350 to 850. Thinking about it on a 0 to 100. Okay. And we're gonna walk through that exercise, and you'll be like, "Oh, Cullen, why didn't you teach me that in 6th grade?" Well, I'm sorry, I didn't want your because I was in 6th grade then too. That's why. Okay. That's why. And then there's another one for the USDA. The USDA has one for buying land in rural areas or in, some people say, flyover country. That's where I grew up. And that is going out living in a rural area. You can't do it to build a commercial farm selling 100 acres of corn, but you can get your own barn and your own barn animals and put fun videos on the TikTok. Those are some of my favorite ones. The kids that live in the little farms, they're awesome. But so those are the basic things, folks. Okay, so just check those. That is the federal government. They are there. They are legitimate. Now, the last thing you want to do, it's just like we talked about going to get a car loan. Okay, did I ever tell you to talk to the car salesman and let him go pull your credit and convince you to get a different kind of car loan from the car dealership? Hell no. We said you run if they try and do that. And you first off, you're walking in there with your pre-approval, your cash, right? Okay. These programs, everyone in the states, you have to use a lender that is officially certified through the state to do that plan. Okay. So when you go to their website, there's going to have a list of the lenders that are there. You will go through one of them. They won't let you use anybody else. So you can't use your buddy who's a mortgage guy that says he's going to get you the great deal. Okay. You tell him to go get a job at the car place because it's the same thing. But what we want to do is remember, you already have found the deal that works for you, and you're already credit ready and qualified for this. And in no way are you interested in any other loan. Don't you pull my credit anywhere else. And don't you even talk to me about anything else. Because if you do, there's a long list of lenders. I looked at the one in California, and there must have been 300 different companies listed that were on the approved list. And if they try to convince you otherwise, you step back from the desk and say, "Jonathan, thank you for your time. I believe I'm going to go find someone that's going to listen to me and to what my plans are that are in my best interest, not in your best interest. Have a nice day."
Absolutely.
Or you can just say F off and get pissy about it, which you might want to do. Or you could just say, I'm buying a place out in the country and I'm going to have a barn on it. And when I get my barn, I might take you out behind it. And you know what happens out there, Jonathan? All right.
Why do you think people keep pigs?
There you go.
Just kidding.
What happens in the country stays in the country. That's a tagline. Somebody, that's a worthy tagline right there. All right, everyone. Thank you again for joining us on this leap year celebration. And we hope and pray that you got lots of good information out of today's show, because I know I did. Wendy, I know you did, and
Yeah.
it was a lot of fun talking about the pain, but also realizing that there's a way around the pain. So it's not just sitting there and complaining; it's actually saying, "This is a plan, and it's an achievable plan." There might be a little bit of pain along the way because you can't completely solve all the problems in the system, but as long as you know where those pitfalls are, you can do your best. You know,
Sure can.
if you're young starting out, going and getting yourself a 2-bedroom condo that's $200,000 on a 10-year loan, probably the smartest financial decision you could make, because you're going to exit that thing and it's going to be worth $300,000. You got $300,000 cash in your next house that's $400,000. You're going to get a 10-year loan for $100,000. You'll have the thing paid off in 5 years.
Oh yeah, property is always the best investment because I'm not making any more land.
That's it. Yeah. Yeah. You have to ask yourself, when you go to that Bankrate calendar, ask yourself one other question. It says on the loan term, 30 years, 15, 20, or 10. Why is there not a 5?
I guess just because it'd be way too affordable, in my opinion.
Ain't gonna make as much money on you.
Yeah.
That's why. That's all.
Mm.
Well, everybody, thank you so much for joining us. Wendy, you want to run the credits and say goodbye?
Well, thanks everybody for joining Total Access and Impact, brought to you by Rental Karma. Special thanks to the whole team at Rental Karma for, loving us and supporting us and letting us put this podcast together. Next week, we're going to be talking about the different ways that you can save hundreds and even thousands on when moving into a new apartment. So make sure to check us out next week at Total Access and Impact. You can listen to us everywhere on Spotify, Apple Podcasts, pretty much anywhere you get your podcasts, or you can also check us out at rentalkarma.com.